Please welcome to the stage our first panel, moderated by Carolina Lacerda.
Good afternoon, everyone. Well, thank you for being here. Thank you for participating in the Inspire conference. We're here today to talk a little bit about the investor side. I think this is the first time that Inspire does this, that talks on the investment side of the hospitality industry. So we're very excited to have some of our industry experts to share some knowledge with us. I'll start with some intros. Well, I'm Carolina Lacerda from EY. In the division of real estate, hospitality, travel, and tourism. And with me, I would love for you guys to introduce yourselves, your company, and talk a little bit about what does the company do and a little bit of your portfolio composition in terms of asset class and in terms of category, so we all understand what we're talking about. Dev?
Sure. Can everyone hear me? Dev Motwani, managing partner with Merrimac Ventures. We are a real estate developer primarily here in South Florida, although we do have assets outside of South Florida. And we build kind of in three major food groups: hotels, luxury apartments, and luxury condos. A couple of our projects are luxury hotels and luxury condos, so I'll talk a little more about that and kind of the synergies between luxury residential and hospitality. We recently finished the Four Seasons in Fort Lauderdale, which was our first 5-star up in Fort Lauderdale Beach. It's the market I grew up in, so it's very near and dear to our hearts. We're also working on a Four Seasons out in Telluride, Colorado, so that'll be our first ski resort. And that's also a hotel with residential. We're building Waldorf, first ever Waldorf Astoria private residences only, so it would be the only standalone Waldorf residences, although there's a couple behind that in the pipeline. Down here, we're working on the Riverside Wharf, which will be a dream hotel. So a little bit of variability within the hospitality space.
Perfect.
I'm Donald McGregor with Gencom Group. We are a real estate hospitality-focused investor, developer, manager, predominantly focused on luxury hospitality, which has gotten us into branded residential over the last 10 years or so, and also with some investments across hospitality platforms, management companies of the sort. I oversee the Latin America portfolio that we have, which spans the spectrum from Four Seasons, Ritz Reserve, Auberge, Fairmont, Rosewood. So work with multiple brands and across most of these assets that I mentioned. We also have a strong residential component, so we can talk about that in subsequent questions.
Hi. So everyone left. Hopefully they went to the pool, right, instead of sitting around here. So Brad Mulvihill, the Chief Development Officer for Oxford Capital. And our properties are largely luxury lifestyle assets. We have, and mostly domestic, if not exclusively domestic. We own and operate all of our own properties, and we've developed some of our own brands. And so, for instance, we have a group of hotels called the Godfrey Hotel. Some of you may know of them. But we also have brands of one, like our London House Hotel in Chicago. We have a Porter, it's called the Porter Hotel in Portland, Oregon. And those two are affiliated with Curio, but most of our hotels are independent hotels, which I think kind of offers us a little bit more flexibility. Trying to think, we have several Thompson hotels, but I think, I guess from my perspective, being the owner and operator, and might, shed a little bit of light on some things, I suppose.
Yeah, no, I think it's interesting. In the U.S., we have a little bit more of a diversified type of investors, right? Here we're talking with 3 private groups, but you will also have the public investor groups. You have REITs. And in other parts of the world, the hospitality investors are going to be a lot more limited in terms of types, right? And you're going to have less fully 100% invested in hospitality funds or REITs that here in the US you have 100% hospitality REITs, family offices that only invest in hospitality as well. And you'll see all of that here in the US, and in other parts of the world, you'll have a more diversified fund or REITs that focus in different real estate classes, right? So I think here with us, and we have a lot of knowledge because it's experts that only see hotels Oxford has a little bit of other asset classes, but you have a big component of
Yes, but so do others.
all linked, right? So when you're looking at deals nowadays, are you looking mostly at acquisition of stable assets, acquisition of assets that need repositioning, development? What do you tend to look? What is your target looks like?
From our perspective, it's mostly been repositionings lately. Construction costs have been quite high, certainly here domestically. So it's just been quite a challenge to kind of make sense of a development, and also finding, getting bank debt or credit fund debt for developments is also quite challenging. So largely repositionings, but that's not necessarily just a hotel, though that could be an office building or some other asset that may be underutilized that we could transform into a hotel, or whatever other real estate class it may be. Most of our focus is hotels, but we have a fair amount of apartments and senior housing and things like that that we use, and at least use that solution for whatever real estate. Whatever property may be suited for.
And is that two brands, your own brands, or is that from one brand to another, or?
We like to say we're agnostic. It's kind of whatever fits. I remember we were developing the Langham in Chicago, but prior to that, we had through the analysis of the investment, we were trying to determine what exactly it's going to be, but just its location and the property itself made it a luxury hotel. And it was a great solution because it ended up allowing for the property to replace its anchor tenant because of this luxury hotel. So it was a really good solution, but that's unique, right? I think that, at least for us, we do more, as I mentioned, luxury lifestyle. So I think that would be our first instinct.
Donald, I know you tend to go more creative in the properties you look at. So what are you looking for when you look at a deal?
I guess a lot of it is market driven, but similarly to what Brad was mentioning, I mean, it's challenging backdrop for development. So most of what's coming to our pipeline that piques our interest is acquisitions of like underinvested, undermanaged assets where we feel there's quite a bit of value enhancement through asset management, renovations, repositionings, et cetera. We find ourselves under quite a bit of development right now, particularly in our Costa Rica project, but that's more a function of part of a bigger project that already has an operating component that we can do bolt-on. And so we'll do a lot of residential still while under the umbrella of hospitality through residential rental programs and whatnot that use the hotels as the main anchors. So I'd sort of bifurcate the development niche into standalone ground-up development. That's probably very difficult for us to make sense of that where we are right now, versus bolt-on developments to sort of complement existing assets that we have. And we think that's sort of where the opportunity is. It's easier to capitalize. There's an easier narrative to tell, and it allows you to leverage sort of proven concepts that a more skeptical buyer of this branded real estate, it resonates better with them. So that's what's keeping us busy.
And is it easier to do ground up in, for example, Costa Rica, or is that just a very unique case?
No, it's challenging. It's challenging. I mean, in sort of the two conflicting thoughts is we're a U.S.-based group, and for us to go outside of the U.S., it has to have sufficient scale. Otherwise, probably isn't interesting enough. And so when you reach certain scale, capital markets aren't as deep in some of the other jurisdictions outside of Western Europe and the US. And it's challenging, but that's sort of what's made the residential component more important. I'd say deals in Bermuda and Costa Rica, and now looking at Mexico, they're making sense in the luxury side because of branded residential to complement the capital stack. Yeah.
Of course. And Dev, I think on your side, it's complete
Yeah.
opposite.
Yeah.
Well, no, it's actually, I mean, it's all very similar. I always joke, I say, all of our Excel models work the exact same. So,
You do more development as well.
correct, but the
Yeah.
development requires right now a residential component from on the hospitality side to make the numbers work. I mean, we had rates move so quickly, which means cap rates have moved quickly. We're all still trying to figure out what cap rates really are over the last 12 months because of all the volatility in the capital markets. And when you're doing development, it's over such a long horizon. But in order to break ground and to get financing, you have to do it at a moment in time.
Yeah.
And so right now, that moment in time is challenging. But if you have a great site and you want to be a long-term owner like we are, and as long as you're not leveraged on your land, you can wait till the right time. But if you have a residential component, luxury condos are still selling very well in good markets like South Florida or like Colorado and luxury ski towns. So we're able to make that work because really the residential is subsidizing the hospitality component. That can change, and I think it will change. Again, because if you have a great site and a great market, this is hopefully a blip. But the market was priced so perfectly in terms of construction costs, insurance, interest rates. Everything was pretty tight, and so all of a sudden in a short period, we had massive inflation, so your construction costs went up. Then you had interest rates go through the roof, and then you also had insurance costs go through the roof. So it was the perfect storm, and you can't raise rents or ADRs in this case that quickly to adjust for that. So there's a hold, but that means that supply will be constrained, and then rates will go up over time, and then in those good markets, and then that means the market will adjust. So we're still actively looking for new sites. And everyone says, well, if the math is hard now, why are you looking for a site now? It's because I'm not going to be getting financing for 3 to 5 years, so I'll worry about that then. But if it's great dirt, we're always a buyer, but we price in that we need the flexibility to wait and wait for good times. So that's our model, and so we're staying busy. And because we do different things, we can kind of focus our time on what's working and hold off on things that maybe need a little more time to mature.
Perfect. And when you're looking at these deals, how do you all look at your capital structure, right? Like you talked a lot about financing with branded residences, helping that as part of the capital structure. Like what are you looking, if you are looking at development, what do you look as your hold period? Are you looking, it's a family office, are you looking at on long term? Is it something that you're looking to turn around in 10 years? What does it look like?
So we're a family business, so we do have investors on projects, but we always start with our own capital, and so we're long-term investors thinking kind of more generationally now. And so that's how we start and we look at a project. That being said, you also have to look from a capital stack perspective, you look at where the markets are and what makes sense in that moment. So luxury residential in certain markets like Florida or even the ski markets, if you're pre-selling condos and you get deposits from those buyers of those units and you get to use those deposits, well, that can offset the equity that you need or reduce the equity and similarly the construction loan that you need. So that capital stack for a residential project looks different. That's why they're working. I mean, the projects are getting subsidized with buyer deposits. If it's a straight hotel, that's very challenging right now because you need more equity in this capital markets environment, which is what makes it harder at this moment to capitalize. So it really is not only project by project, but then also market by market as well, and the specifics of that. And we're not doing anything overseas, but I'm sure it's very interesting in Costa Rica, and I'm sure Oxford is in many other markets. But that's mostly for what we do domestically.
And does it help that it's a luxury product? Do you think that it's easier to pre-sell? Is it easier to get it financed maybe?
It's certainly, we think it helps if you're working with the right brands to sell. It gives people confidence in the product. In some cases, it can be easier to finance because, again, if you're working with an established brand, it can give more confidence to a lender, especially in this environment. But there's also costs that come along with it, which then make it harder in some cases to make it pencil. So it can work both ways. But from a residential perspective, we prefer branded residential because we do feel like there is a good return on that incremental cost.
Got it. And Brad, on Oxford, does Oxford look at specific deal sizes? Obviously, it's not a family office, so it probably has a hold period that's a little bit more.
Yes, we're pretty vanilla in this regard. I mean, we work with largely just opportunity funds, so they'll have their 5 to 7 year timeline, and then they'll have various minimums. But certainly deal size is a factor, as I'm sure everyone here would agree with. The only thing I can say that's at all perhaps unique about how we capitalize some of our deals is we if possible, we'll try and source subsidies, either historic tax credits or some type of TIF in a particular jurisdiction that might be helpful. But those are very specific. Like that's not our goal is to do that, but to the extent it's available, that's something that will likely be required to actually capitalize a deal. We've had some opportunity zone deals, developments, and those will be longer, and those were done largely with family office capital.
And Donald, in your case, if you're looking, is there a difference if you're looking in the U.S. versus offshore, the type of structure or percentage of financing that you look at?
I mean, yes, you eventually have to back into less leverage in some of these other markets. It's just the banks. I'd say there's less expertise on project financing type of sort of underwriting approach to it, and it's very difficult, particularly on the luxury side, to try and sort of prove out an underwriting of a financing with what the cash yields are for the project. And so it's been a learning experience for a lot of the jurisdictions we go into on explaining the creative capital stacks. But a lot of what Dev mentioned, I mean, it's where we are right now, just different circumstances. It's really projects that are working is by and large because of the residential. But you got to be careful also. I mean, we are long-term holders, and so what you don't want to do is just put together a project sort of design composition that solves it to get to the hotel opening, and then you're left with something that's probably not optimal mix, which we've seen over and over again. So I mean, I'd say the weighted average for our portfolio is 8-10 year that we have, current hotels that we have. So we do keep them for an extended period of time versus a more typical fund structure. And I think with that, we take a different approach, not just in how we capitalize the deals, but also designing it, programming it, and our outlook for the general investment.
And in the U.S., does your deal size, what is your deal size in the U.S., for example, in terms of value?
Again, I mean, I wouldn't say we're fixed to parameters the way a fund would be, but 50, 100 million minimum probably for it to be sort of deal.
Pencil. And when looking at the upside potential, I think we talk a little bit about that and how you guys as asset managers as well do a very detailed job on the upside potential of a luxury property. How do you look like defensive versus offensive capital, and what are you looking to add? How are you looking to add value to some of these projects that you get?
You wanna?
Sure. Is it fair to say it depends? Right. I mean, I mean, each property is extremely unique. I think what we try and do is, I mean, we work all of our properties are domestic, and so labor costs are an issue, right? And it's that's just kind of how it is. And if we ever have the opportunity to have capital like a construction project or something to generate, revenue that doesn't necessarily require labor. It's something that we look at, we consider it very, we look at it a lot, I don't know what else to say. But I mean, I think, so that would be, renovating rooms, adding certain other amenities to a property that aren't going to, drive that labor expense. Effectively, what that's trying to do is to take, kind of basically capitalize the labor expense into your development, and finance it that way. I'm not sure if that makes sense, but we look at almost all of our renovations through that lens, at least the offensive ones.
And you operate you operate most of the hotels that it's your own brand. Is that your operation, or you have a third party?
We operate almost all of our hotels, but they're not all our brands. Like, for instance, we operate 2 Thompsons. Like that's Hyatt. That's not Oxford. But for this, and it's the same for all of the ones that we operate, be it our own brands or another brands. Like they're still our hotels. And we.
In terms of, you do most. Do you do repositioning, where you tend to?
We do, through a partnership with Driftwood Hospitality. So we did that at Merrimac, and then we bought into the Driftwood management platform, and we created a series of funds. So we will do, in fact, I have a acquisitions investment committee call right after this. But in each case, we typically look for something significant in terms of value add, and it usually includes a brand change. And so, and it's interesting because sometimes that includes upgrading a brand. Sometimes it might be going down market, depending on what the supply, is in the market and what's coming within a certain segment. But it usually includes a fairly heavy capex requirement or expectation. We do feel that we're good on the management side to bring in costs, but we don't rely on that. We kind of assume that's going to be the gravy in the deal. And then of course, the larger portfolio you have, we can bring some efficiencies on the insurance side and some of the vendor costs to bring your operating expenses down. But ultimately, we go in with a story where we feel like we can kind of take the asset to another level. If we don't have that, we're usually not bidding on the deal.
And you asset manage in-house? You
Yes.
have an asset management team in-house. And Donald, in your case, when you can't change the brand, what do you do?
Yeah, our luxury portfolio is all brand managed, so we're not operating, they don't let you, and so it's really
So
asset
can you do?
management.
Yeah.
It's not easy. I mean,
You manage the brand. That's what that's about.
I mean,
Hope there's no brands in here.
we were talking about that, but I mean, ultimately, I feel that it's a lot of the properties that we'll buy that are luxury brand managed. There's some sort of the relationship between the owner or the brand is in disarray, and that sort of has led to underinvested assets, which sort of spiral in a vicious cycle where then it's difficult for them to attract talent, and so it sort of creates this loop that it's very hard for hotels to get out of that without like a proper shock. And shocking the system is difficult when someone's owned that hotel for an extended period of time. So that's sort of where we've been successful at these turnarounds. We'll come in, work with the brand, given the relationship, still have long term with the HMAs, but extensive change of general on-site management. What we've learned is, particularly in that niche of properties, it's hard to move the needle on the cost side, and it's really how are you completely overhauling your sales and marketing, general stimulating demand for this property. But large component of which, of course, is the renovation, but it's a joint venture. It's a partnership with the brands. Never easy, just managing it with them.
Perfect. And while always important, luxury has been in the spotlight of the hospitality industry now, especially after COVID. So what do you think was about the luxury product that made this, I don't know if it's a change, but it made people think differently about the luxury, and you were able to see huge increases in rates and performance in general. What was it about COVID? And changed a little bit the perspective of guests, but also how do you see that change in terms of rates and how do you underwrite that risk, right? Is that temporary glitch in the system or was that something that's going to stay? How do you as owners underwrite that risk of high increases of rate after a specific event that happens, right? Be it COVID or other events. Brad.
Well, I think that some of our portfolio is slightly different, right? Because it's largely urban center locations, and the rates went up and largely, but occupancies occupancies went down obviously, but occupancies haven't come back to generally where they were before. You have Thursday, Friday, Saturday, you have people staying and paying to do so, but much more difficult Sunday, Monday, Tuesday. So, from my perspective, that's what we need to work on, at least from our portfolio, and probably other hotels, is getting people to come back and stay in a hotel for a business meeting. And I think we all know that a lot of that is going to have to do with when people are coming back into the office and to what degree and to how long. But I don't think anyone really knows the answers exactly how that's going to be. So unlike I'm sure the South Florida properties, they had tremendous gains during COVID. I'd be interested to know, has it kept up? Has the Four Seasons, has it been able to maintain that rate?
So far, but you're seeing people's spending habits start to change. The couple that was upgrading to a suite, is maybe back to to a regular room, still paying last year's rate, but less premium purchasing even within the luxury segment. I think you had this exuberance of people excited to get out, right? People were locked up, especially outside of Florida, locked up for a year plus, and so when they were out and they were happy to spend, they wanted the service and they wanted to enjoy travel again. So I think some of that is still there and will be persistent, but there's no question that some of that has kind of come out of the market, and it wasn't sustainable. The ADR increases that we were seeing in some of these luxury hospitality markets just were it was great, and costs went up too, by the way. It wasn't just rate that went up, but the reality was overall the leisure properties came back up much stronger and faster. So some of that has gone out, and I also think, at least you asked about Florida, we benefited from the fact that we were open earlier. We were also, people weren't going in Europe or traveling internationally. Obviously, that's all come back strong this summer. We saw a lot of people heading back over, and so things are normalizing. But again, that's probably good for the market to take a little bit of a breather.
And when is it normalizing in terms of the ADR stabilizing or normalizing ADR, or losing a little bit of ADR this year?
I'd say stabilizing.
Stabilizing.
Yeah.
And Donna, seeing with your luxury properties in the U.S. and in Costa Rica, what have you seen in terms of performance after COVID?
I'd echo the same, that rates really climbed, but cost went up quite high. So the questions everyone always asks, well, are rates going to come back down? But cost won't.
Yeah.
So I don't think property owners can afford to do much. It's interesting. I think it's almost two stories being told. Are properties that have, the higher ADR properties are still seeing good strength into next year. 1,000 plus ADR properties, they're still doing well. Slightly below, we're seeing some softness going into next year, and I think it's just it's a factor of what the supply-demand imbalance is. The higher it is, the higher the supply imbalance, and so you're still compressing X amount of demand into a limited number of rooms, and so that just gives you pricing power. And the hotel brands are being pretty nimble at managing that demand.
And in terms of trends, right, another thing that came out of COVID was just the experiential travel, right? Guests wanting more than just like another nice restaurant or a nice spa. They want to have real experiences when they're traveling, especially on the leisure side. And even on the urban side, a lot of times they want a little bit more from some of these hotels. So when they're paying these rates of above $1,000, how do you differentiate that? How do you give that extra level of, be it service, amenity, that in order to compensate and make sure that you maintain those rates, right? That you're able to still charge those rates going forward. I know, Brad, in the lifestyle, you also have to be a little bit creative in your...
I would say that the customer put up with a lot during COVID, and they're not willing to put up with it anymore. So, you know, whether or not they want more, they certainly don't want what we were giving them prior to that. So a lot of that has been a challenge because of the tightness of the labor supply, keeping your staff so that they can deliver the experience. It's basically just the service that they're demanding, and and by all rights should receive. I know that we've had a lot of trouble when we have people come work at some of our properties, and it's a good property and it's well regarded in a market, but because of that, then they'll get poached away. I assume that happens at the Four Seasons and quite a bit, which it makes it so much more difficult to deliver that experience. But we don't necessarily do any of the. We don't have $1,000 rates, so it's not anything going to be all that extravagant. But it's mostly getting in and be able to check in quickly, having a clean room. And this may seem simple, but try working in a hotel. It's actually quite difficult, right, to do something like that. And I think, through COVID and then with, the tight labor supply, it's kind of put a focus on, the people who are at the hotel. I know everyone would say that it's a people business. I'm not sure they actually really believed it. Come COVID and, having a restaurant but not being able to actually open because you don't have someone who's available to take the food from the kitchen to the table. Right? I think that kind of opened people's eyes as to what this industry is and how you actually actually how you are successful, and it is largely through your people.
Qualified people, trained.
Yeah, and I also think too. I mean, when you get into the higher end and luxury, there's only so much you can do with the physical space because your project is your project, and you've got a nice bed and a great 5-fixture bath and all that. So then you really are relying on that staff even more to deliver those bespoke experiences and welcome that guest, and that's how you can start to differentiate. So while the power of the brand is great, as you get into the high end, you really have to focus on who's on your property and who's running your hotel, and that's every position, not just the GM or just management, to deliver that bespoke experience to justify that higher rate. I mean, I think that's absolutely critical. The higher up you go in the spectrum.
Donald?
Same labor issues in the U.S., but in the Caribbean and LATAM did not face those issues. At least there was a lag, which was interesting, and quite a lag. But we I'd say COVID forced us to internalize a lot of the experiences, and what I mean by that is the hotel team was used to relying on different outside vendors, and when sort of that model broke, when we were starting to reopen, we took advantage of that opportunity to create different operating platforms, organically grow them, to deliver an experience so that our guests would sort of stay within property more than before. We're sort of keeping the income within our operations, and we can deliver a more consistent service. And that's something that I think is here to stay. We sort of focused it on the teams to software versus hardware component, and I think we got a higher ROI on that software investment versus, maybe let's renovate this restaurant or this grab and go or something. The former actually paid off.
Yeah, I think especially in some of the countries in Costa Rica, Mexico, and Latin America, where you're able to offer more outdoors activity connected to nature. I think that's what we've been seeing at least a lot of success around, right? I think simple things of having a dinner under a tree and you light up the tree, and it's just like something that connects guests more with the property, with the country, and it's just a lot of times people pay more for that than for a Michelin star restaurant inside 4 walls, right? And just a little bit around the branded residential, we we talked a little bit about it, but I just want to understand, you're doing a product right now that is fully branded residences with a Waldorf, right? So how are you seeing that product in the market, and what are some of the challenges and success stories you have?
No challenges, everything's rosy. Once you get past the cost, then it's all rosy. No, it's been a great experience. We just launched. Sales are going extremely well. I think we're fortunate that to be able to work with Hilton and Waldorf to deliver that experience in a standalone residential product, because the brand has such cachet and kind of an allure, particularly to a domestic market that knows, obviously the New York flagship property, but now more properties globally. But our buyer base up in Broward, Fort Lauderdale, Pompano is more domestic, and so that brand resonates very well. But we're talking about these experiences on property, and what we're seeing in the luxury segment is people go, they have these great vacations, and then they realize they want that same experience when they're at home. And so, delivering that experience, residents with an F&B component, with a concierge, with these bespoke, not only amenities, but also experiences, that there's a premium for that, and there's a real demand for that. So we're seeing the benefit not only on the sales price, which is higher, but then also on terms of the velocity of sales. People are really gravitating towards that. But you have to deliver on the experience. You can't just say it, right? Because you're tied to a brand, and you're committed to that. And so it's important that you work together to make it seamless, so you truly are delivering on that promise. And so there's a lot more work that goes in to launching the project. We took our whole team up to DC, and we did a brand immersion, and not just the development side of the principals, but also our sales team, so they knew what they were selling and they could experience it. Our marketing team, so that they knew what we were selling and how to deliver that message. So it's a much more integrated process, but what we found is if you do it right, like I said earlier, the demand is there, that experience is there, and so it's even more important that you're creating that experience at the hotel level to then feed the residential side of the business. And so that's why you're seeing more and more luxury brands go into just standalone residential, because we've seen residential product as part of resort properties, or urban luxury projects, but now we're seeing more and more brands deliver on that standalone experience.
I just have a question. Will the Waldorf offer hotel-like services to the residents?
Yep. Yeah, and our staff will all be trained through their program, and there's a whole immersion experience even for the buyer before we deliver, and so they're given access and concierge services in advance of even taking delivery. We'll have the team on board before we open, so they get to know our buyers in advance. So when you move in, it's not like you're just showing up and they got to get to know you. There will be a whole onboarding process even in advance, so that when you move in, it's like you've been there for a year. And so
are they full-time residences? Generally expected to be?
It's South Florida, so you have a mix of. But it's not really an investor product. I'm sure some investors are buying, but what we're seeing, in fact, the brands certainly bring along investors, but the investor tends, what we've seen is go more towards the product that includes a hotel component. Because then you have the rental program, the standalone residents. I think so far what we're seeing are more end users, a higher percentage of end users.
Yeah, I was going to ask that. It's just so you don't have the rental program option, right? So it's going to be more first, second homes, or people looking to really live there, or at least use it often, right?
Correct. Yeah, I mean, it's like any other condo in the sense if you want to do a long-term lease and rent it out, you're able to, but there won't be any sort of transient usage.
And so, Brad, you guys do a lot of mixed-use residential as well. In this space, do you touch the luxury space in terms of residential?
Not really. We have some residential as part of our mixed-use projects, but they're certainly not to the level of you know, the Four Seasons or the Waldorf. It would be again kind of that luxury lifestyle positioning. So there was an apartment build. We just developed a Godfrey Hotel in Detroit, and adjacent to that there's going to be an apartment building. It's now it's not going to be the Godfrey Detroit Apartments, but they'll be sharing services and things like that. We have a hotel in Chicago called the Essex, which is Le Meridien, which was part of a larger project with, I think it was 500 and some units, 500 and some apartment units, which when it was open, it was branded as the Essex. We subsequently sold it, so that changed its branding. So it's certainly something that we're interested in, but I'm not sure if you get the premiums that you get from some of the brands that you work with something that isn't so particularly luxury, right? I feel like that's, and maybe I'm wrong, but I feel like that's probably where you really see the benefit. I don't know. I'd be interested to your take.
We've tried across the spectrum. What I mean different brands, right? And I guess about 2 years ago, we launched a product with Andaz, so 4-star, I guess, lifestyle.
I'll tell them that.
Luxury lifestyle brand, and did very well. But the source of the profitability will come more through the rental program economics than through the real estate sale part, versus doing Ritz or Four Seasons. Sort of command a bigger sort of premium versus
with those for sale residences.
For sale residences, and then 90+% of the buyers will put them in the rental program.
We've never done it for sale. It's always been just rental apartments as part of a project.
Yeah, what we've noticed is similar. You don't, when you take a step down out of the luxury space, you don't see that for sale, that premium on the sale. But what we do see, the benefit we do see is an increase in velocity. So it's still, you still get the confidence of the brand. You just that perceived premium isn't there as much in the market. And what we found is on the luxury side, there's demand not only for, this is for a mixed-use project, so where you have a hotel or resort and then you have a residential component. There's demand for two different types of for sale product. One would be the branded residence, the hotel residence that is available for the rental pool, but then also private residence, which is just a branded condo within the same complex that somebody wants to enjoy but doesn't want to, wants to be separated from the transient component. So we did that successfully in Fort Lauderdale. And we had a separate entrance, separate lobby, separate elevator core.
Separate amenities or no?
So what we found is in some cases separate amenities, but we find that those that are in the private residences actually enjoy having common amenities. But they still want to be separated,
They want the exclusivity of entering as their own place.
Right. When you're in a hotel, it's great. You have all the services and amenities, but then you also don't want to deal with maybe the traffic in the arrival porte cochere. You want to have your own entrance, and you want to be able to get in and out in a different way. And so in Telluride, we're doing the same thing. We have both products because we're seeing that, again, that in these markets where people do want to live. I mean, it does assume that people want to live there either full-time or second home markets where they want that separation, but they also want all the benefits on site. So we'll tend to do a larger gym and a more full, robust amenity program, which benefits both the resident condo owner as well as the guest. So it tends to be a win-win as opposed to separating them and having kind of duplicative amenities.
And Donald, in your experience, that you do have branded residences within the rental program, you look at both, right? You look at how it helps you finance basically the development of that, but also like the income that is coming through the rental program.
Yeah, absolutely. I mean, it's been very profitable for us, this rental income that contributes greatly to the NOI that your property generates. A little bit harder for lenders to underwrite that income the way they do on your regular hotel keys, but I think they're learning that go back 10, 15 years on properties that have the vintage. I mean, people are leaving these units in the rental program just for extended periods of time. They're not. It's not sort of volatile. And it also sort of, it's pretty balance sheet efficient. You're not putting your money on 2, 3, even at least for my resort properties, 4 or 5 bedroom homes that it wouldn't make sense for us to have. So someone else is paying for that, and then they're using them for, on average, for these resort locations, 2 to 3 weeks a year. And so it's de facto part of your hotel inventory. And on a post-COVID world, that multi-generational travel demand for 3, 4, and 5 bedroom villas just skyrocketed. But just on pace for next year, we don't see any softening on sort of, it sucked some of that demand from hotel keys into those branded villas.
And if it doesn't rent, it's not your problem.
No, I mean, they're paying HOA, so
Yeah.
we're still doing well, even off of, unoccupied.
Exactly. Well, we're out of time, so thank you. If you have questions after, they'll be taking questions outside of the conference. At least that's what they told me. So thank you, everyone, for the time, and thank you, panelists, for your knowledge.
Thank you.